Right now, there is a 35-year high in unsold, newly completed inventory. So developers, naturally, well, they effectively are pulling back and stopping to build new homes for the future. Now, does that sound like a crash to you, or is this a massive supply shortage in the making? Today, we are going to share the British Columbia Real Estate Association's forecast that prices could rise as much as 27% over the next 6 years. We're also going to dive into the Bank of Canada's latest move to hold rates and discuss why 1 in 5 businesses are planning to cut jobs this year. Also, why the tiny condo era is officially killing the Canadian housing dream. Let's get into this week's data. Starting off, of course, we saw the Bank of Canada this week, and they held rates as basically all the markets had predicted, and leaving the overnight rate at 2.25% for the second meeting in a row. The tone of the meeting, it was essentially that, quote, the climate is too uncertain right now. You can say that at any meeting because it's always uncertain, but sure, it does feel elevated right now. The bank is ultimately comfortable with where the rates are right now, with potentially no moves for the rest of 2026. The governor didn't provide too much forward guidance other than they are prepared to respond. Yeah, that's your job. But, when we look over at the Canadian overnight repo rate average forecast, we get insights into what is predicted for the overnight rates going forward a full 5 years. So if you are renewing your mortgage or thinking about buying soon, the segment is definitely for you. Right now, projections forecast interest rates to, as aforementioned, stay flat for all of 2026. But then they're going to increase gradually to a total of 100 basis points over the next 5 years, at 3.25% overnight rate by the year 2031. So while 5-year projections are, they're impossible to predict, you may want to take this under consideration, especially if you are considering a variable rate mortgage. Based on today's economics, it would appear prudent that locking in would be the better bet over the next 5 years. Of course, you always need to have that discussion with your lender before making any decision and ensure that it's exactly right for you and your situation. When we look at the prediction markets, though, they've actually shifted dramatically since Monday. Even on Tuesday, they were predicting a 60% chance of a quarter point increase at the June 10th meeting. That had increased to 92% chance by September. But after the BOC announcement where they held rates, even though they were expected, it lowered. The markets changed their predictions and lowered to only a 29% chance of a hike all the way out in December. So looking at what types of mortgages people are taking recently, if you want to, if you're in the market and you want to know what everybody else is doing, right now, variable rate mortgages are by far the most popular, with 43% of mortgages in that state. 5-year fixed, currently the least popular, with only 10% of mortgages going that option. So my guess, though, based on what I just talked about, I think these percentages will shift dramatically over the next year, with fixed becoming more popular once again. Either way, if you're in the market, talk to your lender and plan accordingly.
Yeah, Dan, you make some very good points there. One's got to wonder to what degree are the CUSMA negotiations going to play a role in the Bank of Canada not really giving much guidance in terms of cuts or hikes here. I typically see whenever the central bank stops giving guidance, it's usually some form of uncertainty, which is the dominant value in their equation. So, I think the rate hold should be not seen as confidence, but seen as caution. I think the BOC is trying to be as accurate as they can right now. But ultimately, they need to leave the door open for flexibility. And I think that, like you said, nobody really knows the path, how we're going to get to those 100 basis points, but it's certainly going to be interesting. Speaking more to the rate cuts here. So the markets have predicted the last 10 or so moves by the BOC correctly, but they aren't perfect, and they're certainly not always right. There are some economic cases for a rate cut this year. So let's have a look at that. The amount of EI recipients has increased by 16% year over year, hitting 570,000. This is a notable increase from the 390,000 registered just 3 years ago. Next up is the share of businesses expecting job cuts in 2026. That rose to 21% last quarter, the highest reading since the data began being collected back in 2017. And lastly, Carney looks to be keeping his promise to trimming the size of the total government in terms of its workers. Just last week, and 1,000 federal workers were told that they might be laid off. These three factors could pressure the BOC to consider a cut in 2026, and I guess we'll see.
So we've been discussing sort of the rapid decline in the new home starts, especially in the GTA and in the Greater Toronto area, as the current high levels of inventory, they've sidelined developers, right? They simply will have no need or no ability, or there's no appetite to bring new product to market when there's so much available today. When we look forward, there are currently no projects and therefore no new homes completing as far out as 2029 and 2030. And it's quite similar here in Vancouver as well when it comes to those numbers. And while, of course, it's hard to visualize today, when that current inventory is absorbed over the next 5 or so years with nothing being built after that, well, there very much could be a shortage again. As mentioned, it is happening in Vancouver as well, and it's being flagged by the British Columbia Real Estate Association, who they released a press release just this last Monday highlighting the potential risks of repeating what we did in the 2010s. Quote, BC risks repeating the post-global financial crisis housing cycle, where weak demand boosted inventories and slowed construction. Sound familiar? Only to leave the province severely undersupplied when demand rebounded, triggering rapid price escalation and worsening affordability. We've seen it before. Will we see it again? Well, the Real Estate Association projects that without intervention, i.e. the government coming in to aid or create some policy changes to help in the construction of new homes to bridge that gap, that prices will increase 27% by the year 2032. Now, I can already hear the hateful messages being typed into the comment section, but who has the audacity to say that prices are going to go up 27% in this market? Well, what do you think? Is it the association just trying to pump the market because that's their job, or is there some data to support their theory? Let's break this down a little bit further. Vancouver real estate is funny in the sense that when prices are ripping higher, the general consensus in the marketplace is that they will continue forever, so that it's a safe buy in that environment. I mean, take this for example. When we look to peak market, right, March of 2021, prices had increased 14% in just the 12 months prior. And when people saw that happening, it resulted in the most amount of homes sold in any month in history in our region, right? People had full confidence that, hey, they were going to go up, I guess, forever. It's just an interesting mindset when it comes to buying homes. And of course, the opposite mentality arises when prices are going down. Right? People feel like they will continue to go down forever, so they just don't buy. 2025, I think, was a perfect case in point here, where we just saw a 25-year low in sales volumes as prices continued to drop. So back to the idea of prices increasing, right? 27% over the next 6 years. When we break that down annually, it's a 4% increase per year, right? If it were to average out. And when you look at it through that lens, it sounds slightly more plausible, especially when it comes to comparing prices to what's happened here in the last 20 years. Even though we've seen prices drop in Greater Vancouver for 4 years in a row, including that, but going all the way back to the year 2005, which is as much data as we have, bring that up to today, prices have increased on average every single year by 6.97%, call it 7%. So 7% for 20 years on average. So when the Real Estate Association suggests the potential of a 4% increase over the next 6 years, is it entirely impossible? I mean, sure, this time's different, but again, these are numbers that we've obviously seen historically happen. So whatever your take is on prices, it is interesting to see the association flagging the shortage of new homes under construction and the potential ramifications for 6 years from now. So the question is, will that fall on deaf ears, or will there be some, structural shifts within our industry?
I think, when you consider the rate of inflation, right, let's consider it at 3% as a general rule of thumb, a 4% increase over the next 6 years, assuming that we do see prices continue to inflate, money printing continue to go on, quantitative easing. I don't know how we get away from that over the next 6 years. I can see maybe where this is going. I guess the question is whether or not it'll be 6 years or 10, but I guess we'll see. But kind of to your point though, Dan, the supply of new inventory is typically a 5 to 10 year runway, right? And if we stop building over these next 5 years, it's very much possible that it creates an environment where you get price pressure pushing up. Anyhow, Let's move over to unsold inventory now, further galvanizing the potential for future housing shortages. The amount of completed and unsold inventory continues to climb, reaching a new record as of December. The amount of completed and unsold homes hit 19,000 last month. That's up 35% year over year. This hits a 35-year high, eclipsing the previous record of 18,091 units in January of 1991. Inventory is 52% above the 35-year average. Of those, 4,000 are in Toronto, with 5,458 of them in Vancouver, just 4 units shy of the 1995 record, equaling 49.7% of all inventory in Toronto and Vancouver combined. Very few developers have the capital or the appetite to launch new product in this environment, and how could you blame them? Meaning all of this unsold inventory will need to be absorbed before we see a notable amount of shovels in the ground. That's the elasticity that has to be taken out of the supply.
One group that will definitely not be buying any of those homes are the people who are leaving the country, because it is happening at an increasing pace. In fact, Canada saw a record amount of people leave the country last year in 2025, with 54% of those who left driven by, or being, workers aged between 25 and 49, right? The productive, if you will, people within a country. The emigration levels rose 3% year over year, and it marked the fourth consecutive year of growth. So it did hit a record. Last year, there was 120,016 people who left the country. There were over 16,000 seniors that immigrated in 2025. Interestingly, that number is up 80% in the last 10 years. So pick your poison as to the reasons why so many people are leaving, but you can likely place, housing, the cost of living, healthcare, and our current government probably near the top of that list.
I don't want to just brush over this point, because I think losing, your working age Canadians, it's a huge, huge problem, especially when the 25 to 49-year-olds make up more than half of those that are leaving. That's your core tax base. That's your household forming demographics. That's historically the strongest buyer of real estate in our marketplace. And, people just don't uproot their lives lightly. I think, we have a record number of people leaving. It's a sort of big warning sign that's flashing. And it's something that we really need to address as a country, whether that be tax reform, whether that be opportunities for younger people. But if we don't have those younger people here, it's going to make the future much more difficult. Speaking of that, let's look now at job cuts. Let's add the employment list to that mix as well. We saw the highest amount of businesses planning to downsize in over a decade. The BOC's Business Outlook Survey for Q4 of 2025 shows 21%, that's 1 in 5 businesses, are planning to cut staff in 2026. That's the highest since 2016.
Yeah, we're seeing basically an overall decline in home ownership in this country. And it is a paradigm shift, and it is accentuating as home prices and cost of living increase. More and more, especially young people, well, they simply have to wait longer to get into that housing market, or they don't ever become homeowners. But interestingly, the change in home ownership rate has declined over the last decade for every single age group between 25 years old up to 74 years old. Very interestingly, the only group that's seeing an increase in home ownership is between 75 to 84-year-olds, and amazingly, 85-plus-year-olds. I mean, YOLO, I guess, right? You're getting that vacation home finally. But not to make light of it, I mean, look, we are sharing right now a chart that shows the declines here. And youth between 25 to 29-year-olds, they have seen their rate of home ownership drop 7.6% in the last decade. And the next group, 30 to 34-year-olds, they are down 6.9%. With obviously rental rates continuing to lower and look to lower over the coming years, more and more young Canadians will likely become longer-term tenants, potentially never buying. This could become a concern if the historical trend of renters being vastly less wealthy than homeowners continues. While there's nothing inherently wrong with renting, obviously, the data shows that the behaviors most renters have needs to shift in order to match or beat the long-term wealth growth that homeowners have experienced for the last half century. At the same time, finding the path to more affordable homes to purchase, along with lowering the cost of our day-to-day living, would understandably flip this narrative around as well.
Kind of like the chicken or the egg. It's hard to know how to get what comes first. I mean, do you rent so long and hope that you can save and get all the way to eventually buying your own home? Or do you choose different racehorses in the long run and hope that outpaces it? It's hard to know. I guess the question that I have is, what homeowners have experienced over the last 50 years, is that going to be the same experience in the next 50 years? Are we going to see that level of growth be higher? Will it be lower? I don't know. I think inflation is going to play a big part, though. Anyhow, let's look at BC retail sales. We look to retail sales here as an indicator of not only what people are spending their money on, but how much of it. Interestingly, last month, retail sales numbers jumped 1.3% in November, up 3.1% year over year, hitting an all-time high. This indicator is showing no real pullback in spending. Surprising considering the low consumer confidence metrics that we've seen as well. Though that is emotion, this is hard data. In BC, the spending was even more pronounced, up 1.8% month over month and 4.2% year over year. And what's most notable is what people are actually spending their money on. Clothing, shoes, and jewelry are up 10%, as is health and personal care and food. Building materials are down 6% as people move away from renovations during this time. A far cry from the 2021 boom. With real estate sales volumes at 25-year lows, it appears people are spending a bit more on themselves by the way of clothes, healthcare, and food.
Yeah, a bit more affordable to pick up new shoes than a new duplex, that's for sure. So next week, we will have the update on January sales, the first month of 2026. How's it doing? I think the only teaser I will provide is sales volumes are going to end up down 25, maybe 30% lower than last January. And that was, a year that panned out being the slowest in 25 years. So sluggish as always, but we'll have the full details for you here next week, including what happened with prices. So stay tuned, but have a wonderful week for now, and we'll see you here next week. Take care. Bye.